I think the opportunity here is to be short, Tom. And very rarely we talk about shorting our own asset class, but credit is priced for perfection, as you said. And some markets are telling you there's something wrong, like gold or silver, right? That's a very bright red light flashing. And then other markets are completely complacent. And that's credit and rates. And it's for the same reason, right? Central banks are keeping the pedal, they're pushing the pedal, they're pushing the liquidity accelerator. And even though the economy is still running pretty well, we are looking at something like 4% growth in the US. If you look at GDP now, maybe close to 4%, and yet we have cuts. So credit is priced for perfection. And the dollar is taking the hit right now. But the moment that foot goes a bit off that pedal of the liquidity acceleration, then credit will start widening.
So, Alberto, what do you make of the private credit market? That's something new for investors to kind of get a handle on here. It's such a big market. It's become such a big market over the last 15 years. How do you look at that market and maybe some of the risks that may be in that market?
We are short the whole private credit ecosystem in every way, shape, or form, and we have been since over a year ago. The reason is you have a compilation of issues. First of all, the growth has been too fast. When some markets grow, 3.5x over a period of a few years, you're trying to lend you're trying to gain market share. You're trying to lend to people. And you're always going to capture some sort of adverse selection. You're going to capture the borrowers that cannot get lending from banks or from other people. So there's an adverse selection problem. And the reason why we started to look at private credit is because the companies that we like the least in public markets were switching to private markets. So companies that had bad governance, companies that had something to hide. There's also conflict of interest, because if you look at the buyers of the private credit products, they tend to be in U.S. life insurers, and many of them are owned by Apollo, by KKR, by the same private equity and private credit managers. So ultimately, we see there is adverse selection, there is extreme growth, there is a conflict of interest, and all you're gaining are very low returns. The returns have been modest, single-digit returns with capital lock. A lock of capital of up to 5 years, and you're getting 7, 8, 9% return according to Apollo data, and that's in the best market conditions that you can get in the last 3 years. So you don't really get paid for it. There's adverse selection, conflict of interest, and we see the first cracks opening with First Brands and Tricolor and software now, and there's huge risk concentration. 41% of private credit exposure is software. So would you invest in a fund which is 40% in one trade? Probably not. We want to invest in things where we want to put our capital in, and so we continue to be short. We think these are the first cracks in the space. Investors are just starting to look at it and realize that what they have in their books is not transparent.
Alberto, what do you make of some of the large tech companies coming to market with huge amounts of new credit issuance here to fund the AI trade?
So look, the interesting thing is at the same time as private credit was growing a lot, there was a lot of need for capital in the AI space and the software space. And so that's also how these firms managed to lend to the software and tech sector. And the large hyperscalers have been smart in putting a lot of their debt and their funding off balance sheet, but that's not always available. So you have other firms like CoreWeave, like TeraWulf, like Cypher that essentially have funded the need for infrastructure for the hyperscalers, but that debt is not on the hyperscalers' balance sheet. We see a lot of expectations, a lot of assumptions of future growth, future profits. But the thing is, if you're a stock buyer, if you're buying the equity or a convertible bond, you're buying the winners. If you're buying credit, you're essentially betting on the losers. You're essentially betting that no credits will default. And when spreads are really tight at 2-3%, what that means, imagine you're lending $1 each to 100 firms. You don't need the whole portfolio to go bust. You just need 2 or 3 to go bust to erase the return of 1 year. The margins are really thin, and you don't get paid.
Alberto, very quickly here, just from a distance, your take on the American private credit market and the retailization of it in 401ks, in IRAs, in individual retirement plans.
Tom, I think it's bad. I think it shouldn't happen because there's no disclosure, and the firms that have sold private credit to large institutional buyers over the past few years, they're now trying to get a way to sell the same products to retail. And I think regulators eventually should look at it. Now, It's very important that loans are not securities, so loans are not regulated. And that has given the private credit managers some leeway to do this. But ultimately, regulators have to protect consumers.